Just wanted to update you. Aritzia just reported its results for the first quarter, and they did beat estimates. Adjusted profit came in at 22 cents a share, and that was ahead of the 17-cent consensus, and it actually more than doubled year over year. Revenue went up almost 8% to just under 500 million, and the estimate was for only about 487 million, so it was a beat there. Comparable sales, okay, they were up 2%. Now, I'm not sure exactly what the analyst consensus was on comparable sales. They are getting big, though. 119 stores they now have. That went up 4% almost year over year. Their current quarter forecast for revenue looks a little soft. Could be as low as 570 million. Could be as high as 590. But the estimate is for roughly 584. So they're warning that sales could miss estimates in the current quarter. However, they do, for the full fiscal year, see revenue of between 2.5 and 2.6 billion. And so they're sticking with that. The revenue estimate from Bay Street is about 2.6 billion. I'm talking in rough terms there. So certainly a beat in the latest quarter from Aritzia, but the sales forecast for the current quarter looks a little lighter than expectations. We'll have lots more about that. If I see any analyst commentary in the next little while, I'll let you know. In 2021, 33 companies went public in Canada. But since then, nearly half of them have returned to private markets. And experts say this growing trend of companies avoiding or leaving the public markets is hurting Canada's productivity. Our guest says corporate governance, the increasingly elaborate requirements, is one of the issues pushing companies to stay private. We're joined now by Bryce Tingle, N. Murray Edwards Chair of Business Law and Professor at the University of Calgary. Thanks very much for coming on the show.
Thank you for having me. It's a pleasure to be here.
It's not just a phenomenon in Canada. I know JP Morgan has decried it in the United States, companies avoiding the public markets. But what do you what is the main thing holding Canadian companies back from going public?
That's the million-dollar question. I've been working on this problem since 2013, I think is the first time I published on it. And the only answer that seems to fit all the facts, that this decline is going on in multiple countries all at the same time and in multiple industries and market segments. The only answer that really makes sense of all those facts is that our corporate governance regime, the reforms we've made to corporate governance over the last 30 or 40 years are discouraging entrepreneurs, corporate managers from taking companies public, or as you say, keeping them public.
That's just increasing bureaucracy and red tape and scrutiny because it takes up an awful lot of a company's time.
Yeah, it does. And it's all of those things. Our corporate governance reforms for the last 40 years have been predicated on an idea that the whole point of corporate governance is not so much to make companies work better, but to ensure managerial loyalty. We've built our corporate governance on the idea that managers are susceptible to acting in their own interests and sacrificing the interests of shareholders and other corporate constituencies. And so our corporate governance has been mostly designed to tie the hands of managers. So it's not that surprising that managers find our public markets less and less appealing.
I can't quite follow your reasoning there. Sorry, can you give me an example of a rule that's been brought in that ties the hand of executives?
Sure, I'll give you a couple. So back in the 1950s, most Canadian companies had a large number of inside directors. These are directors who are members of management as well as sitting on the board of directors. But beginning in the 1980s, we started encouraging companies to have only independent directors. And in most Canadian companies these days, the only inside director is the CEO, him or herself. Every other director is independent of management. And the reason we did this is we thought independent directors would do a better job of monitoring management. Another example is we have spent the last 30 years increasingly prescribing the ways that we want our senior executives to be paid. And we've done that because we've thought, well, there's certain problems that we have to fix with managers. We need equity incentives to ensure that their interests are aligned with the shareholders. We need pay for performance to ensure that they're properly motivated. When you look at the 90 some-odd governance rules we now impose on companies, most of them are designed to direct or control management.
That's interesting. And obviously, yeah, bureaucracy is the plague of any business person. I know small business person, people, it drives them mad. They have to run the business and then spend the whole night filling out forms. One other factor we're hearing, actually, the Globe and Mail just had an excellent article by Jameson Burko on this. I think he talked to you. The rise of private equity. They have lots of money. And of course, they're happy to buy companies in some cases instead of taking them private. Or taking them public, I mean.
Yeah, that's true. And I think the rise of private equity is part of the answer. But it's not the main answer. For the most part, the kinds of companies that traditionally have gone public in Canadian markets have been too small to be interesting to private equity funds. They also have tended to be disproportionately sort of innovative companies. The kind that don't have assets that are easy to value or establish cash flows that are easy to model and borrow against. Mm-hmm. So it's not the case, I think, that private equity is mostly to blame for the decline in IPOs in Canada. I think the much bigger problem is that managers are simply deciding that rather than go public, they'll just sell the company to a large competitor. And in some industries like technology or pharmaceuticals, there are very few to no companies in Canada. And so mostly it means these Canadian businessmen are selling to foreign tech companies like Google or Apple or Merck.
Is this, I mean, we've heard laments about the lack of Canadian productivity growth. Is there a link here between a dearth of public companies and low productivity?
Yes, there is. For the people who study, so Canada's productivity is a disaster, and it is the most important economic issue that we face as a country. It's received a lot of attention from economists and from policymakers, including, of course, the Bank of Canada, which described it as an emergency a few months ago. Mm-hmm. For the people who've studied it, it's very clear that the problem in Canada is not that we don't come up with good ideas. We do come up with good ideas, and we start companies at about the same rate as other countries in the world, in particular the United States. The problem is that we don't scale those companies up here in Canada. We tend to sell them when they're still small. And if those ideas get scaled up, they get scaled up south of the border or somewhere else in the world. So very much public markets, which have historically been the place where companies could scale up and hire lots of employees and continue to innovate, create a Canadian institution. Their weakness is, I think, crucial to understanding why we don't scale business the way we used to.
I know this is a complicated question, but should we be twisting the arm of our gigantic pension funds more to buy Canadian equities?
I don't think that can hurt. That is a policy that is being advocated very strongly for in the UK. If you read the debate, it's very hard to be certain whether or not that's the right move. There's no question that as our markets have gotten weaker, our pension funds have begun looking elsewhere to invest. And there's also no question that on a per capita basis, there is very little money focused on venture capital, early stage entrepreneurial finance compared to other countries like the United States. So it falls in the category of stuff that can't hurt. I have always favored the idea that if we have a problem, if there's a problem in the incentives such that managers don't want to go public, but they'd rather just sell the company to someone else, that the most promising thing to do is see if we can just adjust those incentives, make our public markets a little more attractive to corporate managers.